Okay, so you want to build a gold refinery. Melt down raw, dirty ore, straight from the earth, or recycled scrap jewelry. Purify it into gleaming 99.99% pure kilobars. And tap into a global trade worth over $300 billion every single year. Sounds like a bulletproof money printer, right? I mean, you're literally holding the ultimate symbol of wealth in your hands. But here's the strange part. Gold refining is a business where you can process tens of billions of dollars in pure precious metals every year, and yet operate on razor-thin profit margins that would make a grocery store owner sweat. And it's also the business where a single fraction of a percent error in your chemical math, or one compliance mistake with an illicit supply chain, can instantly wipe out years of profit and send your company straight into liquidation. Anyway, by the end of this video, you'll know exactly how gold refineries operate on the inside, how the money actually flows through those bubbling vats of acid, the hidden capital costs that burn through reserves, and why a gold refinery isn't really a metal business at all. It's a high-stakes, hyper-precise financial clearinghouse that happens to use high-heat furnaces. To understand how you even get into this game, you have to realize that gold refineries come in two main flavors, and they are completely different operations. On one end, you have small-scale secondary processors or scrap shops that cost maybe $3 to $5 million to set up, handling pawn shop jewelry and electronic waste. On the other end, you have massive LBMA-accredited primary refineries like Valcambi or PAMP in Switzerland, handling hundreds of tons of d'Or bullion straight from industrial gold mines. A facility like that easily costs $100 million to $200 million just to build, equipped with military-grade security vaults, chemical scrubbers, and automated minting lines. Now, let's talk about the raw material cost and how the money actually flows in, because this is where most people get the economics totally wrong. Refineries don't just buy gold cheap and sell it expensive. Here's the thing. Gold is a hyper-liquid commodity with a real-time global spot price tracked down to the penny. If a mine ships a refinery 100 kilograms of raw d'Or bar containing roughly 80% gold, the refinery doesn't pay for that bar up front, out of pocket. Instead, they charge the supplier a processing fee, often called a treatment or refining charge, which can be as low as $0.50 to $2 per troy ounce for large volumes, plus a tiny percentage cut of the yield, usually around 0.1% to 0.5%. Think of a refinery like a toll booth on a high-value bridge. You aren't buying the cars driving across. You're just charging a microscopic toll for every vehicle that passes through your lane. A top-tier refinery might process 400 metric tons of gold a year. At current prices, that's over $30 billion worth of metal moving through the building, but the refinery's gross top-line revenue from refining fees might only be around $30 million to $50 million. That is a gross revenue yield of barely 0.15% on the total value processed. So, how do they actually squeeze out a real profit? They rely on secondary revenue streams and meticulous chemical efficiency. Modern gold refining uses two main methods: the Miller process, which blows chlorine gas through molten metal to reach 99.5% purity, and the Wohlwill process, an electrolytic bath that pushes purity up to 99.99%, the legendary 4 nines pure gold required for investment bars. During this process, the refinery doesn't just strip out impurities. They extract valuable trace metals like silver, platinum, and palladium that were trapped in the raw ore. Extracting and selling those byproduct metals can add an extra 10% to 20% directly to the refinery's operational bottom line. On top of that, refineries make money on fabrication and vaulting, turning a standard pure gold sponge into a stamped 1-ounce decorative bar. A cast kilobar, or minted coins, allows the refinery to charge a minting premium. A retail customer buying a 1-ounce minted bar isn't paying pure spot price. They pay a 2% to 4% premium over spot, and the refinery captures a healthy chunk of that markup. But here's where the math gets brutal and terrifying. Look at the operational costs that eat away at those thin fees. First, you have energy and chemicals. Melting gold requires induction furnaces running at over 2,000 degrees Fahrenheit. And the Wohlwill electrolytic process consumes massive amounts of continuous electricity. Add in hundreds of thousands of dollars spent on hazardous chemical disposal and environmental air scrubbers to neutralize dangerous toxic fumes, and your basic utility and chemical bill can devour 25% of your operational revenue. Then comes security and insurance, which is a massive fixed cost. You're holding hundreds of millions of dollars of physical gold on site at any given moment. Armed transport, biometric access control, multi-ton underground vaults, and comprehensive Lloyd's of London insurance coverage eat up another 15% to 20% of revenue. And then there's the invisible monster: standard process loss and working capital drag. When you melt and chemically digest hundreds of tons of metal, a tiny fraction of a percent vanishes into slag, airborne dust, or gets stuck in the brickwork of the furnaces. Refineries have to do quarterly sweepings where they crush their old brick linings and scrape floor dust just to recover hundreds of thousands of dollars in microscopic gold particles. If your chemical process loses just 0.05% more gold than your equations predicted, your entire profit margin for that batch completely evaporates. Furthermore, consider working capital and interest rates. Gold doesn't sit in a vat for free. While the metal is being refined over 24 to 72 hours, the refinery often has to hedge the price of gold on futures markets like COMEX to protect against price swings, or pay interest on unallocated gold pools borrowed from bullion banks. When interest rates rise, the cost of financing that physical inventory skyrockets, wiping out net margins. After accounting for labor, security, energy, compliance, and capital depreciation, a typical refinery's net profit margin on gross processing fees ends up hovering around a razor-thin 10% to 15%, which represents a fraction of a percent of the total gold value moving through the doors. So why do some gold refineries still fail despite this volume? The number one reason is supply chain failure and counterparty risk. If a refinery accidentally accepts gold linked to illegal mining, conflict zones, or money laundering networks, global regulators will swiftly sever their access to London Bullion Market Association accreditation. Losing LBMA status is an instant death sentence. Major banks and institutional investors will immediately refuse to trade your bars, turning your multi-million-dollar facility into an expensive scrap metal shop overnight. Look at historical cases where major regional refiners lost their bank credit lines due to compliance failures. They collapsed in weeks because they couldn't finance their daily operations. Another silent killer is volume starvation. A high-capacity refinery is a capital-intensive machine with massive fixed overhead. If gold production drops or mines route their door bars to a rival refinery offering cheaper fees, an underutilized facility will bleed cash fast. If you build a factory meant to process 50 tons a year and only get 10 tons, your fixed security, energy, and compliance costs will eat you alive. So, what is the ultimate payoff scenario? When a gold refinery achieves massive scale, secures long-term offtake agreements with major Tier 1 mining conglomerates, and maintains pristine LBMA compliance, it becomes an unbelievable cash flow machine. It doesn't matter if the market price of gold is surging or crashing. In fact, high volatility drives even more trading, recycling, and physical minting demand. At peak efficiency, a top-tier refiner processes vast volume effortlessly, earning steady, predictable cash flow off every single gram of metal that passes through its vats, turning dirty rocks into pure, unadulterated financial yield.